Welcome everyone to RFC1011, an introduction to accounting. My name is Richard Driscoll. I'm your module coordinator, and your other lecturers you'll meet in due course. But a special welcome to our George campus, where you have Mrs. van der Merwe. This year is the textbook that you will be working from. You can see it's called Applied Accounting. So if you haven't already purchased that textbook, go and find it. In the first two chapters, we're going to be looking at ethics, accounting terminology, and the accounting cycle. That's chapters 1 and 2. But chapter 1 I mentioned very briefly, and then we'll move on to chapter 2 and get going with the real work. And also you might have received in an email from me the module guide, and you're able to pick up the module or syllabus guide, which tells you all about RFC 1011, what's required for you to get through the year and pass the module, or pass, this is a semester module, RFC 1011. But when you get back to class, your lecturers will tell you all about what's required and work through the module guide with you. But like I said, I have emailed one to you, so it is available if you want to look through it. What's happened now is we've gone online. There are always these disruptions at the start of the year, so it's nothing out of the ordinary. But you're going to be given videos to watch like this, and you will get a link to the video. You already know that if you're watching this video. It is very important also to click on the link once you've watched the video to complete your attendance or registration document. It's done on Microsoft Forms. You must complete that, and don't forget to push submit. So you fill in your first name, your surname, your student number, where you're studying, George, the GQ or PE, right? You need to mark that as well and push submit. Just before we get onto some more formal work, just some information I need to share with you. It's important during lectures to remain silent. Okay, in my class, there will be time to interact, but that is up to the lecturer when they want to interact. When there's silence, it's quite easy to focus, so we don't want any distractions, and we don't want to make the content harder than what it actually is. So the lecturer doesn't want to compete with noise. Also be considerate to your peers. If you're not too motivated, please don't distract those around you. What we're trying to do this year and every year is we make accounting fun. This particular subject is a life skill. You all need this, and it will add to what you know and what you're learning, and the more knowledge you have, the greater chance you have of success. So please be respectful to your lecturer and the students around you. If you're late for class, please enter the back of the classroom and sit at the back. We the students, or we the lecturers, we are to serve you. We want you to do well. Just some background. In all the videos that I create for RFC 1011, I use a case study, Calibre Education, which sells educational videos, and these are the following role players so you don't get confused. Calibre Education sells to the school. The school has an account with Calibre Education. Calibre Education buys from the computer store. We'll look at cash and credit transactions. Calibre Education banks with not FNB or Standard Bank, but the bank. And Calibre Education has its own little office, its own premises, and that's the company vehicle. This is a sole proprietor, so the vehicle of Calibre Education. Right, ethics. The first chapter in the textbook is on ethics. I will only use this slide to talk about ethics, just to point something out to you guys. So ethics is about principles and values, and it's about doing what is right, fair, and responsible. It's your framework to what's right and what's wrong. Everyone's framework has developed differently depending on your environment. Right, a good work ethic. This is what we should all have. If you want to do well in anything, you need to work consistently. You need a good work ethic. You need to stay motivated even when the going gets tough. You need to manage your time well. You need to put in proper effort into learning and completing tasks. In accounting and maths, you will get exercises to complete. You need to complete those exercises. The exercises we do focus directly on how you're going to be tested in tested and exams. You need to do the tasks that you are given. Like watch this video right until the end. Right, just a good workplace ethic. When you get into the workplace, if you haven't already been there, you're going to have to act with integrity, responsible, be professional, contribute positively to the team, right? So there will be a workplace ethic. And then we're doing accounting. The accounting information must be recorded honestly, accurately, be transparent. You don't want to hide any numbers. The information must be trustworthy. Decisions are made responsibly. So you're entering into a field where it's very important to be able to be trusted, right? The accounting information needs to be accurate and honestly reported. Right, what is accounting? Accounting is a system. It's a system of double entry where all transactions are recorded, and we'll discuss what transactions are. Those transactions are reported on and they become useful information. All these transactions are recorded accurately and they are summarized in financial statements. This information is used by a whole lot of stakeholders, managers, owners, investors, banks, suppliers, the government. Accounting helps all these users make good decisions about whether the business is profitable, financially stable, or worth investing in. So accounting is a system where all the transactions, all the events of the business that affect certain elements, assets, liabilities, owner's equity, all those transactions are recorded in a proper system. These days you can get free accounting software, but you'll only understand the software if you go through a course like this. So there's a definition of accounting. You can stop the video and watch this, or you can read it. Right, remember you're reading through, now I'm on chapter 2 in the prescribed textbook. Right, users and uses of accounting information. There you got your users, investors. People might want to buy shares in your business if it's doing well, so they want to see the financial records, the accounting records. Employees, they're concerned about whether they're getting fair remuneration, fair pay, so they would be concerned if the business is profitable or not. Labor unions, they're concerned about the company's financial statements to see if their members, all the members of the labor unions, are being treated correctly. Lenders, if a company wants to borrow money to expand, the banks that are lending them money need to know that the money that they lend will be paid back. Suppliers, right, suppliers are quite concerned if you buy something on credit, whether they're going to get paid or not. Customers want to know if you're going to be around for a while, because they're busy building a relationship with you, the company, your customers. Government are interested in your financial result for taxes. The public are interested. Management needs information to make sound decisions. So those are all the users of financial information, and all this information can be used. So note there's a difference between users and what are the uses of financial information. You can determine the financial position. You can determine the financial result, whether there's a profit or loss. How much are you spending in certain areas? You can use the information to plan ahead. Are the policies in place the best for the business? Obviously that will link to your goals, your business goals. Should work be outsourced? For example, should certain functions of the business be done by a more specialized enterprise out there? Are the activities profitable, or which activities aren't profitable? Which products are selling? Which products aren't selling? So there we go. Just a brief introduction to users and uses of accounting information. Right, forms of ownership. This year we're going to focus on a sole trader. So you are the owner of the business of a sole trader. I'll look at some advantages and disadvantages of a sole trader. One owner, and you can have many people working for you, but there's one owner. So for example, Calibu Education, our case study, is a sole trader, a sole proprietorship. The advantages: easy to set up. It's not expensive. The owner makes all the decisions. Not many legalities to start up. Not much capital is needed. Less tax. And all the profits belong to the owner. Right, disadvantages: there's unlimited liability. What unlimited liability means is often your personal possessions are linked to the success or failure of the sole proprietorship, the sole trader, your business. So if your business goes bankrupt, you might have to give up some of your private possessions to cover the debt of the business. So there's unlimited liability. Obviously these things can be negotiated, but generally speaking, a sole trader has unlimited liability. the owner can lose his or her possessions if the business fails. Sometimes it's difficult to raise capital because the money is coming from yourself. It's difficult to lend money if you're not big and you're small, so you don't have too much surety. Like, say for example, I can lend R1 million from the bank, but then my house is used as surety. If I can't pay back the loan from the bank, my house could be repossessed or auctioned. But it's not as easy to raise capital because a sole trader doesn't have the ability to sell shares in the same way a public company can. Right, income tax, it's taxed at the owner's personal rate. So the more the owner earns, the more tax they're going to pay. And also in a sole trader, you should be on hand if you want your business to be a success. So it's quite time consuming to be a sole trader. I'm going to go through a few accounting concepts or terminology. What is an account? Right, an account in accounting is a structured record used to track all increases and decreases in a specific financial item, such as assets, liabilities, equity, income, or expenses. We will learn all about those different classifications of accounts: assets, liabilities, equity, income, expenses. But an account, and here's an example of the equipment account, which is actually an asset. And in this account here, there was equipment worth 210,000. I can see we disposed of some of the equipment. You will learn all about this through the year, but this is an example, and it documents all the transactions relating to our equipment. This is an example of an account, the equipment account. Right, what is the general ledger? The general ledger is a central accounting record where all a business's financial transactions are summarized and organized into individual accounts. So the general ledger will have the equipment account, the bank account, the trading inventory account. All our accounts will go into a book called the general ledger. So on your software, accounting software, there will still be a general ledger where all the accounts are recorded. So here's an example, just the general ledger of Calibre Education, a few accounts: interest on current account, the telephone account, the wages account. So there are a number of accounts as examples of what's inside a general ledger. Right, accounts payable. Now, accounts payable is also known, maybe to some of you, as creditors control. So when we buy something on credit, accounts payable is the amount a business owes to suppliers for goods or services received but not yet paid for. We've bought these items on credit, and that is why it's called accounts payable. And accounts payable will consist of all your individual creditors, like Builders Warehouse, Builders Express, the computer store in our example. So accounts payable are your suppliers from whom you've bought on credit, also known as creditors control. Creditors control and accounts payable is exactly the same thing, just different terminology you might find in different textbooks. Accounts payable is a summary of all your individual suppliers, creditors. Here I just extracted a creditors control account. So everything that was purchased on credit, 89,320 from different creditors. This is a control account. So it keeps a record of all the individual creditors. The creditors ledger, which we do much later, will have all the individual accounts. And here I'll just show you the creditors were paid. These other transactions, we will look at them at a later stage, but that is accounts payable. Accounts receivable. Now if we sell on credit, so people or institutions have an account with us, it's called accounts receivable or debtors control. Someone that we sell to on credit is called a debtor, and this accounts receivable is the account name that your textbook will use. Some textbooks will use debtors control. Accounts receivable is the amount a business is owed by customers for goods or services delivered but not yet paid for. So we sell something on credit, the item gets delivered, and we are paid at a future date. Or if we're not paid, it might become a bad debt. More about that later. And there's an example. That number there was the credit sales for the month, 41,470. Don't stress about all the details in these accounts. We will deal with them in more detail. I'm just showing you what the debtors control account looks like. At the moment, we're looking at terminology, accounts receivable, debtors control. So I could have called that account there accounts receivable. And there's a balance brought down of 0, which means that worked out quite nicely. All our debtors paid. There's the money we received, and then there were a few other transactions like discount allowed, bad debts. More about those later. Right, what is an asset? The definition of an asset is important. Every single transaction will have accounts involved, and you need to classify them correctly. For example, equipment is an asset. So an asset is a resource owned or controlled by a business. We bought equipment, for example, and now we own it as a result of a past event. Simply, the past event means we bought it, and it's expected to provide future economic benefit. We are going to use the equipment to make a profit, future economic benefit. The asset is relevant to the business. We're not going to buy equipment for a different type of business. We're going to buy equipment for our business that we will use in our business. And this asset, equipment, should be fairly valued. So after 1 year, the equipment is not going to be worth R1 million anymore. It's now worth 900,000. We're not supposed to overstate our assets, so we depreciate the assets. So Calibre Education has an office. There it is. It's worth X amount. That is an asset to the sole trader, the sole proprietorship. Calibre Education has a car, a vehicle. It's an asset to the business. Cash on hand is an asset to the business. The computer I'm busy working on is an asset to the business. They're assets because they fit the definition of assets. Right, cash is an asset. Right from cash to something that's not easily converted into cash, a building. Order of liquidity, that's something we will look at in a while. Furthest away from cash, not liquid, to cash liquid. Those are just accounting terms. And there's another asset, and the asset is the school. It's a debtor, a place we sold to on credit. A debtor is an asset. We're going to get cash from the school in due course. They have an account with Calibu Education. Calibu Education sold to the school on credit. The school is a debtor, accounts receivable, and asset. Now you get different types of assets, as I've mentioned. You get a non-current asset. Now, current in accounting means the current period we are reporting on, the 12 months we are reporting on. So if your financial year is from the 1st of January to the 31st of December, that is your current year. Now, non-current assets are assets that you will have for longer than the current period. For example, a vehicle you will have for quite a few years. A building you will have for quite a few years. Equipment you will have for quite a few years. These are not current, they are non-current assets. So a non-current asset is a long-term resource business owns or controls that is expected to provide economic benefit, profit, for more than one financial year. Now, current assets. So we had assets and we had non-current and current. Cash or debtor, the school. It's either cash or something that's converted into cash very quickly. For example, trading inventory. So there we go. Current assets. What is trading inventory? It's the stock that you buy and sell. That is a current asset as well. Right, what is a business entity? A business entity is an independent economic unit whose financial activities are recorded separately from its owner's affairs. So the business entity, there's actually a rule, a business entity rule. The business's transactions and the owner's personal transactions are recorded separately. So there's the business premises. There's the owner's home. Those are two separate entities. This here is the business entity. That is a personal asset. It has not got to do with the business. So if the owner buys food, that is not a transaction that relates to the business entity and shouldn't be recorded in the business's books. Later on we will concentrate more on the business entity rule. So a business entity is separate to the personal space of the owner. Right, what is capital? Capital is the amount of money that the owner invests in the business, representing the value they have contributed. The owner makes 100,000 Rand capital contribution, and also if the business were to end, you could go to the capital account and you would see what the owner has put in is actually the interest the owner has in the business, and the owner is entitled to what the owner put in, right? It's the owner's interest. But the owner's interest, you will see, will be calculated by saying the value of assets minus the value of liabilities, but more about that later. So capital, the owner can put in cash. The owner can actually contribute a vehicle as a capital contribution. The owner can raise capital by lending money from the bank. So capital is what the owner puts into the business, and it doesn't always have to be cash. Right, drawings. Now, drawings is what the owner takes out of the business. The owner can take drawings of cash or stock or equipment, and you will learn how to record this type of transactions. Drawings are the amounts the owner takes out of the business for personal use. So let's say, for example, the owner took cash out of the business. You would have a transaction where if the owner took cash, you would debit drawings and you would credit bank. Then the owner would take the cash and go and pursue some personal transactions, buy fruit. Okay, so the owner can take cash from the business and purchase personal goods, but don't get confused. When we do this transaction, we don't record in the business's books that the owner bought apples and pears, etc. We go and make an entry, debit drawings, and if it's from the bank account, credit bank, or if it's from petty cash, credit petty cash. So the owner 9 times out of 10 takes cash for personal use. They can take stock as well, and we'll show you how to record that later in the year. Right, so capital and drawings, the owner's accounts, are also known as proprietary accounts. And in the general ledger there you'd have capital and drawings. But more about that as we go on. Remember, this is just an introduction to terminology. I'm only going to go on for a few more minutes and then I'm going to stop lesson 1. And don't forget, you're going to read, this is chapter 2 out of your textbook. Chapter 1 was ethics, but I dealt with ethics right at the beginning of this video. You're going to read chapter 2 and then I'm going to carry on. This video should follow your textbook, the order exactly. So read. Right, historical cost. Now, historical cost price, the cost price is the price that the business pays for an item, okay, excluding VAT. So the cost price is the amount the business pays to acquire an item before any markup or profit is added. I'll give you an example. Calibu Education buys a vehicle for use, delivery, for 165,000 Rand. That is the cost price of the vehicle. This, remember, excludes VAT. If you buy from a VAT vendor, the amount that is recorded, the cost price, is the amount less the VAT. What is a creditor? Now, a creditor is a person or institution that remember we're always looking in this case study as if we're doing the books of Caliber Education. We purchase from a creditor, the computer store, items on credit, say for example tablets to supply students. A creditor is a person or business to whom the company owes money for goods or services received on credit. So in this case here, Calibu Education buys from the computer store to sell items on credit, but they bought from the computer store on credit. That's a creditor, or you could say supplier. Creditors result in accounts payable, which we discussed earlier. So in the books of Caliber Education, the computer store is a creditor. Right, I'm going to make this the last slide. Well, this will be the last topic, the financial period. Right, a financial period, a financial year, is the 12 months that we are reporting for, the current period. I have mentioned current before, so it's 12 months in a row. A 12-month reporting period that the business uses to record, measure, and report its financial performance and position. A financial period is a specific span of time over which a business measures and reports its performance. So, financial year, financial period, current year, current period, all mean the same thing, right? The financial year, 12 consecutive months. Can run from the 1st of January to the 31st of December. It can run from the 1st of July to the 30th of June, 12 months in a row. Right, I went through current. What does current mean? Current means the 12 months that the business is operating in or reporting on. For example, the 1st of January to the 31st of December. One financial year, from the 1st of January to the 31st of December, 12 months. And like I said, it can be any 12 months in a row. So what I'm going to do there is I'm going to stop this lesson. We've been going for 36 minutes. You need now to click on the link that will take you to register for the class, saying that you have watched this video. And this is the end of lesson 1. So look out, I will post once again when lesson 2 comes for your second lecture, another video, and again you will need to register for the class to say that you attended the class. That is very important because the administration and the executive of the university need to know who has registered in this online period for classes. It's important that you do that. But the link will be there. You click on the link, you fill in your student name and number, and there's 1 or 2 more questions there, and you push submit. So we have a record that you attended class. Okay, I will send the link to lesson 2, or maybe we're back in class, but look out for your emails. Chat soon. Cheers. Bye.